We will walk through how to correct VAT in Denmark in a structured, low-risk way, so you can avoid costly filing mistakes and unnecessary discussions with the Danish tax agency, Skattestyrelsen. We will focus on practical steps for finance leaders, controllers, and accountants who manage Danish VAT, whether in a local business or as part of a broader Nordic or European footprint. To set the scene, Danish VAT is governed primarily by the Danish VAT Act and administered by Skattestyrelsen, with core principles aligned to EU VAT rules. That means the expectations are clear, but the margin for error is small. Incorrect VAT can trigger interest, surcharges, and, in more serious cases, audits that consume disproportionate management time. Most mistakes are not intentional. They arise from misclassification of transactions, incorrect VAT codes in ERP systems, misinterpretation of exemptions, or incomplete documentation for cross-border trade. The key is to identify and correct errors early, using the formal mechanisms available, and to embed controls so the same issues do not reoccur. Before you correct anything, you need clarity on the error itself. Start with a structured review of your VAT postings for the relevant period. Common red flags include large manual journals to VAT accounts, unusual fluctuations in output or input VAT from one filing period to the next, negative VAT bases without clear commercial explanations, and high volumes of reverse charge transactions that are not reconciled to underlying invoices or contracts. For businesses trading in goods or services across borders, pay extra attention to intra-EU supplies and acquisitions, exports, and the use of Danish versus foreign VAT numbers. Errors in zero-rated exports or intra-EU supplies can be particularly sensitive because they depend heavily on documentation and correct reporting in both the VAT return and any EC sales listings. Once you identify a likely error, quantify it carefully. Determine which periods are affected, whether the error is recurring, and whether it impacts output VAT, input VAT, or both. For example, if you discover that you have been incorrectly applying 25% VAT to an exempt financial service, you may have over-reported output VAT. Conversely, if you have claimed input VAT on costs that relate to VAT-exempt activities, you may have overclaimed. In Denmark, the correction approach depends on both the size and the nature of the error. As a starting point, smaller errors that fall within recent filing periods can typically be corrected through an adjustment in a subsequent ordinary VAT return. This means you include an adjustment line that increases or decreases your reported VAT, supported by internal documentation that explains the reasoning, the calculations, and the original mistake. When doing this, consistency is critical. The adjustment should be booked in your ERP system so that the VAT accounts and the trial balance reconcile to what is reported to Skattestyrelsen. For more material errors or issues that stretch back over multiple years, you may need to submit a formal correction, often referred to as an amended VAT return or a request for reassessment. In practice, this usually involves compiling a written explanation, a reconciliation of the original filings to the corrected figures, and supporting schedules, which may include invoice listings, contract excerpts, and relevant correspondence. You should be prepared to demonstrate not only the amount of VAT that was wrong, but also why the original treatment was incorrect and why the new treatment is compliant with Danish and EU rules. Regulators respond far more constructively when you present a clear, self-critical narrative and show that you have already initiated internal improvements. One crucial dimension in Denmark is timing. Danish VAT is normally filed monthly, quarterly, or half-yearly, depending on the size of the business. Each filing has a statutory deadline, and late payment can trigger interest and surcharges. When you identify an error that results in underpaid VAT, you should correct it as soon as reasonably possible, even if this means making a standalone payment before all details are fully documented. It is generally better to stop interest from accruing and then refine the documentation than to wait for a perfect correction while costs build up. In contrast, when the error leads to a reclaim, ensure your documentation is robust enough to withstand review. Skattestyrelsen may scrutinize large refunds more closely than underpayments. Communication is another key element. While not every correction requires proactive dialogue with Skattestyrelsen, it is often advisable for significant or complex issues, particularly where interpretation is involved, such as the VAT treatment of digital services, complex leasing structures, or cost-sharing arrangements. A concise, well-structured letter or submission that sets out the facts, the legal basis, and the calculations can help frame the discussion on your terms. And if your business is facing a systemic issue, for example, because an ERP configuration has misclassified thousands of transactions, it may be worthwhile to seek a binding ruling for the correct future treatment, in addition to fixing the past. The financial implications of VAT corrections in Denmark extend beyond the tax itself. Interest and surcharges can be substantial, and misstatements can have knock-on effects on financial reporting under IFRS or local GAAP. Companies with group reporting obligations may also face scrutiny from group auditors, who will expect clear evidence that errors have been quantified, corrected, and controls strengthened. To avoid repetition, use each VAT correction as a trigger for a short, focused root cause analysis. Ask whether the error originated from a misunderstanding of VAT rules, a process gap, an ERP or master data issue, or a lack of training. Then define targeted actions, revising VAT code logic and validation rules in the system, enhancing the month-end VAT reconciliation process, introducing more robust checks for cross-border transactions, or running brief trainings for staff who create invoices or post journal entries. Embedding these measures can materially reduce the likelihood of future corrections and strengthen your position in any future review or audit by Skattestyrelsen. As you refine your approach, consider building a VAT control framework tailored to Denmark, but consistent with your global tax risk management. This could include documented roles and responsibilities, a risk-based review of high-value or high-risk transactions before filing, and periodic sample testing of past VAT returns. Many leading companies also maintain a simple VAT issues log, where they record identified errors, decisions, interactions with the authorities, and follow-up actions. Over time, this log becomes a powerful tool for demonstrating good governance and for onboarding new finance team members. To close, VAT in Denmark is technical, but it is also manageable when approached systematically. By investing in timely detection, structured quantification, appropriate correction channels, and strong documentation, you can convert potential filing mistakes into controlled, low-impact events. That discipline not only helps you avoid penalties and disputes, it also builds credibility with Danish authorities and stakeholders, and frees up your finance team to focus on value-adding activities rather than constant firefighting. If you operate in Denmark, treat VAT correction not as a one-off cleanup, but as part of a continuous improvement journey in your tax and finance processes.